Hi guys, I hope you are doing well. This is Lukman Rafiq here. I am the tutor for the paper APM. I've been in teaching profession for more than 14 years now, and I have been delivering lectures on the various subjects, including the APM. This specific video is to quickly revise the various topics, various areas of APM. So I've tried to keep this video short. I'm expecting to deliver more and more videos. So this video is going to be the first of a series of videos, which is going to be for the revision of the APM course. So best of luck, guys, and I hope that you will enjoy the video. Hi guys, I hope you're doing well. Let's just start discussing about the strategic management accounting, that what exactly is in a strategic management accounting. So first of all, let's talk that what do we mean by the word strategic. When we talk about the word strategic, the strategic actually refers to the board level. The strategic actually refers to the board level. When you plan for the long term, when you plan for the overall business, when you plan at the top level of the organization, that is what generally the strategic planning generally means. When we talk about the strategic management accounting, it actually refers to the changing role of the management accountant that is expected of the management accountant nowadays, which is the management accountant is expected to play a strategic role for the organization, that is to give a direction to the organization, that is to give an idea of the organization that what exactly do they have to do in the long run. So what actually happens is that when we talk about the strategic management accounting, there are multiple things that you need to keep in mind, that an organization has got different levels. There is a strategic level, there is an operational level, there's a tactical level. The objectives at the different levels are different. For the strategic level, you talk about the long-term goals. For the tactical level, you talk about the medium-term goal. For the operational level, you talk about the day-to-day short-term goals, routine, daily routine things. That's what you talk about. So generally speaking, what an organization does is that the starting point of any organization is to have a vision. That is, what is the ultimate goal the organization is going to achieve. And once the ultimate goal is achieved, then you set out your mission, you define your mission. What is that mission statement? The mission statement is that how you will be able to achieve your vision. That's what the mission statement tells you. And in order to make sure that we are able to achieve our mission, we actually set different objectives. What are the objectives? The objectives are the short-term goals that are being set in order to achieve the mission. There is a general principle which is what gets measured gets done. So in order to make sure that whatever that we are thinking of, whatever the mission that we have, whatever the objectives that we are setting, those objectives are actually being achieved. So what we do is that we introduce the performance indicator to measure the achievement of the objectives. And those performance indicators are actually termed as the key performance indicators. And there are two different types of the key performance indicators. And what are those two different types of performance indicators? That includes the financial performance indicators, and that includes the non-financial performance indicators. The financial performance indicators are the ones that are actually connected to the organization's financial statements, which includes the different type of ratios, including the profitability, liquidity, efficiency, etc., different types of ratios. Then you've got non-financial performance indicators, the things which are not covered up in the financial statements, which could include the quality, which could include the customer satisfaction, which could include the brand loyalty, which could include the brand image, and the multiple types of things. Now, basically what happens is that traditionally the organizations, what they used to do was they used to focus majorly on the measurement of the financial performance indicators, because that usually reflected that how the organization is performing, and that was the only way that people knew that this is how we could measure the performance. But over a period of time, there was actually a shift, and now the reliance on the non-financial performance indicator has actually arisen. So generally there are different types of non-financial performance indicators that are introduced within an organization, but always remember that whenever we are actually measuring the performance of the organization, the performance of the organization is measured, the KPIs are introduced using the CSFs in mind. So the different types of CSF that the organization could actually have.
The critical success factor, they could be derived from different sources, which is the industry, that is from the structure of the industry in which you are operating. Like for example, if you are operating in an industry which is going towards technological advancement, your critical success factors might be derived from the industry, maybe derived from the competitive strategy, the industry, the geographical location, maybe derived from the environmental factors, maybe derived from the temporary situations that is being faced by the organization. So there could be different sources of the CSF. The CSFs could be categorized into the four categories: internal, external, monitoring, or building. The internal are the ones that deal with the issues within the organizations of the manager's control. The external are the ones which deal with the issues outside the manager's control. Monitoring CSF are the ones that focus upon monitoring the performance of the organization, and the building CSF are the ones that focus upon the growth of the organization. So you just got to make sure that when you are introducing the CSFs, when you are introducing the KPIs, they are aligned with the CSFs of the organization. Now, generally, the KPI could be short-term focus, the KPIs could be long-term focus. So the short-term focus KPIs would be the ones which would try to achieve the short-term targets like immediate profitability, etc. But the long-term KPIs would talk about developing the organization, establishing the organization's brand, establishing the organization's reputation. That is what it is. Now, so when we talk about the overall strategic management accounting, there is one thing that you need to understand, which is that historically the role of the management accountant was more of a one who is into the costing, who is internal focus, who is actually focused upon um, the budgeting and the operational role. That is what it was. But nowadays, what has happened is that the role of management accountant has actually changed, and the management accountant is expected to play a more of a strategic role, which would include providing information, compiling information, giving insight about not just the internal factors but even the external factors that are relevant to the organization. That's what the management accountant is now expected, the role the management accountant is now expected to play. So that is something that you would have to keep in mind when it comes to the management accountant's role. Burns and Escapins, they talked about the changing role of the management accountant, and they were like that the management accountant's role nowadays is actually changing, and the three major factors, the three major forces that drive the changing role of management accountant includes the management structure, includes the technology, include the competition. What do we mean by management structure? That is, the organizations, they have now started to focus more on delegation. So the delegation of the task, the delegation of responsibility is now being done more within the organization. That ultimately leads towards I repeat, that ultimately leads towards the um, the changing role of management accountant. The second thing is technology, the management information system, the other type of information systems that are actually being introduced within the organization. They are also focusing towards the increase, the changing role, and the competition, the external focus the organization have focused upon. That has also resulted in the changing role of management accountant. So overall, the advantage that the organization actually gets because of the changing role of management accountant is that the management accountant produces information which is more valuable, more external focus, and more supportive with respect to the modern day decision making. So that is all about the general idea about what the strategic management accounting is and what the management accountant's role is. Okay, so now we start discussing about benchmarking. Let's just start what a benchmarking is. So when we talk about the concept of benchmarking, benchmarking simply means performance comparison. Now, what do we mean by performance comparison? So when we talk about the benchmarking, it's one of those exercise, it's one of those activity where you compare the performance of the organization with the best performing organization. So like for example, if you wish to compare the performance of an organization, you would identify the best performing organization within your industry, within your line of business, and you would compare your performance with that organization. How do we compare it? So in order to actually apply the benchmarking, first of all, you need to actually identify what type of benchmarking do you need to go about. Like there are different types of benchmarking. It could be internal benchmarking, it could be external benchmarking. The internal benchmarking is that when you compare your organization within within the, I mean, like when you compare different departments, that's an internal benchmarking. What's an external benchmarking? The external benchmarking is when you compare yourself with somebody who is an outsider. For the benchmarking to go ahead, a very important step is that you identify what exactly is the reason for benchmarking. Is it the whole performance of the organization? Is it the specific department of the organization? Is it the specific function of the organization? Is it the specific product that you wish to benchmark? What exactly do you want to benchmark? So very important point is you need to identify what is benchmark, what is it that you want to benchmark. So whatever that you wish to benchmark, the steps for the benchmarking are going to be, you need to identify what you need to benchmark. The second step is that you need to identify the comparator with whom you are actually going to be benchmarking. The third thing is that you need to identify the key performance indicators and the drivers that you will be using for the benchmark. What do you mean by the performance indicators and the drivers? Like for example, profit is one of the performance indicator. The driver of the profit could be sale, the driver of the profit could be the profit, the capital employed. So if the driver of the profit is sales, so it's going to be profit divided by sale as a performance measure that will be used for the benchmarking. If the driver is capital employed, then it's going to be profit divided by capital employed. That is what is going to be used for the measurement of performance. So what you do is that you identify what to benchmark, you identify the comparator. The third step is that you decide what performance indicators, what performance measures will you be using. The fourth step is that you measure the performance of your own organization and the comparator organization. You measure the performance and then you compare the performance, you identify the gaps, you specify the actions that are going to be taken to close those gaps, and then you implement your actions, and then you continuously monitor. There are a few advantages of benchmarking, and that advantages is that you actually are focusing, you can have an external focus, you can compare the performance from the multiple aspects, from the multiple areas, you could compare the performance. But there is actually a disadvantage of benchmarking, which is that the other party may not share the accurate information. The two organizations may not be operating in the same circumstances, in the same environment. So these could actually be the issues with the benchmarking. So the benchmarking exercise may not actually yield the result which the organization may be intending to achieve. But still, the benchmarking is a good exercise, because what you do is that you identify a comparator, you identify a benchmark, and you try to be like that benchmark. You try to be like that benchmark. So benchmarking is a strategic management accounting technique used for the improvement of the organization's performance. We have got SWOT analysis, which is the strengths, weakness, opportunities, and the threats. SWOT analysis is one of the models that's used for the appraisal of the organization. So ideally speaking, what as an organization you should do is that you should identify your strengths, weaknesses, you should identify the opportunities that are available and the threats that a business faces. What an organization must do is that it should utilize its strength, it should try to overcome the weaknesses, it should try to capture the opportunities, and should try to avoid the threats. So generally speaking, what happens with respect to the SWOT analysis is that as an organization, when it comes to the performance management process, you would obviously be focusing upon introducing the performance measures, and those performance measures would focus upon whether you are utilizing, whether you are actually encashing your strengths or not, whether you are trying to overcome the weaknesses or not, whether you are actually availing the opportunities or not, and lastly, are you actually avoiding the threats well or not. So for example, if you come across a situation where the examiner says that perform a SWOT analysis, so you would discuss the strengths, weakness, opportunity, threats, and the examiner would say that introduce or suggest the appropriate KPIs for them. So what you would do is that you would suggest the measures that would measure what the SWOT analysis suggests to us. That is, we should utilize our strengths, we should overcome our weaknesses. So your measures would be measuring whether you are overcoming the weakness or not. Your measures would be measuring whether you are avoiding the threats or not. Your measures would be measuring whether you are availing the opportunities or not. we talk about the BCG Matrix. What is BCG Matrix? It's a Boston Consulting Group matrix. Now, the BCG matrix has got two purposes. One of them is it's termed as a portfolio, and it's a portfolio evaluation tool. At the same time, it is also considered to be a resource allocation model. What does BCG matrix does? The BCG matrix, what it does is that it it basically classifies your organization's products, departments, divisions into four categories. What could be those four categories? That could be a star, that could be a cash cow, that could be a problem child, or that could be a dog. What do you mean by a star? What's a cash cow? What's a problem child? What's a dog? So what the BCG matrix does is that it actually plots these products onto a graph where you've got on one of the axes you've got a market share, and on one of the axes you've got the market growth rate. What do you mean by market share? The market share actually means the share of your product, of your department, of your division. So the share could be a high market share, could be a low market share. What is a high market share? A high market share actually means that your market share is actually greater than the competitors. A low market share actually means that your share is lower than the market leader. Similarly, there is a market growth rate. What do you mean by market growth rate? The concept of the market growth rate is that this growth rate is compared with the industry growth. This growth rate is compared with the industry growth. What do you mean by compared with the industry growth? So for example, if the industry is growing by, let's say, 2%, and if basically the overall economy is growing by 2% and the sector in which you are operating is growing by 1%, that means it's a low growth rate. So generally speaking, what happens is that your products could be categorized on the basis of the growth rate and on the basis of the market share that you have. So for example, if you have got a product which is operating in an industry where there is a low growth rate, and you also have got a low market share, so that is going to be a dog category product. Our dog category product, as per the BCG matrix, is one of those products that is consuming your resources, that is actually causing you a loss. So as an organization, what you should do is that you should get rid of your dog category products. That is, you should divest your dog category products. Secondly, when we talk about the other type of product, if we have got a low market, if we have got a low growth rate, but the market share is high, so that means that product is considered to be a cow or a cash cow. That means you've got a high market share, the growth rate is low, so that means the other competitors are not going to jump into it, and hence you would be enjoying your market position. A cash cow is something that actually helps you generate more and more profits without a huge amount of investment getting into it. So a lot of businesses, what they do is that they prefer to have cash cows, and so ideally what you should do is that you should try to maintain your cash cows. What do you mean by maintaining the cash cows? Maintaining of the cash cows would actually mean that you ensure that they are operating properly the way they are operating. The second category is that when you've got a high growth market, so in a high growth market you could either have a low market share or you could have a high market share. In a high growth market, if you've got a high market share, that means it's a star category product. What you should do is that you should invest more and more into this product as per the BCG matrix, and you grow your product. So you grow your product. Ultimately what happens is that by growing that product, you enhance your market share, you enhance the market penetration. That is something that you do. What happens is that with respect to this, the fourth one, which is basically a situation where the market growth rate is high but the market share is low, that's a question mark, or that's a problem child. What you need to do is that you need to analyze the problem child. Once you analyze the problem child, the result of analysis of the problem child is that either you continue with that problem child or you get rid of it. So if you continue with your problem child or you get rid of it, so that is what you have to do, because your problem child would ultimately become a future star, or it would ultimately become a future dog. So BCG suggests you got to analyze and you got to decide if you have to be with it or not. There are advantages of using the BCG. The advantages of using the BCG is that you know what to do with a product or a portfolio. The disadvantage is that BCG is very subjective because there are two extremes, which is a high growth, low growth, high share, low share. There is nothing as between medium share, mediocre share, nothing like that. You could either be on the extreme end, you could either be a dog, you could be a cash cow. You could be a star, you could be a problem child. There is no such thing in between. So it's a very subjective, very judgmental type of a model. Now, can this BCG be used as a performance measurement model? Yes, a lot of organizations actually use it. Why? Because what they do is that they would try to, when you are using a BCG as a performance management tool, what you would try to do is that you would try to introduce the performance measures for each of your products like cash cows and the question marks and etc. And you would try to measure whether the BCG suggested approach or the strategy is being achieved or not. Like for example, if we have got a star, so the proportion of investment that's being done on a star, the growth in the market share of the star that has been achieved. If you have got a problem child, so for how long the problem child continues to be a problem child, all these things are something that you would actually consider. So the BCG could be used as a performance management tool. Now, always remember, if the examiner comes across a question on the BCG, just make sure that if in order to calculate the growth rate, you could use either the geometric mean method or you could simply use a simple method, a simple growth rate, that could also be used, the simple growth rate method. So that's all about the BCG. Okay, now we talk about the Porter's generic strategies. That what exactly are the Porter generic strategy? So the Porter suggests that there are three different type of generic strategies that an organization could follow. What are they? They could be cost leadership, they could be differentiation, they could be focus, or we could say niche player. Now, what is the cost leadership? The cost leadership is when, as an organization, what you try to do is you try to be the lowest cost producer. How would you be a lowest cost producer? You would try to achieve the economies of the scale and you would try to reduce the cost of the production of your organization. That is something that you would do. You would have a higher bargaining power where you could actually purchase at a lower cost, at a lower price from your suppliers. That is something that you're going to do. The next thing is to have a differentiation strategy. The differentiation is to stand out, to be different, to be unique, and usually the differentiation is achieved from the innovation, from the durability, from a better reliability, multiple things. Generally, with respect to the differentiation strategy, the advantage, the benefit that you get as an organization is that your profitability is enhanced. Why is the profitability enhanced? The reason being that what you try to do is that you try to actually, I repeat, what you try to actually do is you try to make sure that you stand out, and if you stand out, you will be able to charge higher margin, higher selling prices, and ultimately your margins are going to get higher. The third one of them is a niche player or a focus strategy. The focus strategy could be when you focus on a specific market and the competition in that market could be on the basis of cost or could be on the basis of differentiation. A lot of people, what they think is that the niche player strategy is something that means that you're going to be charging high. No, it's not like this. The niche player strategy could actually be decided on the basis of the competition. The competition could be on the basis of cost. The competition could actually be on the basis of differentiation. Now, so generally speaking, what happens is that when it comes to a niche player, you create a brand loyalty, you create people, because you focus on a specific market, so you develop your niche, you develop a specific league of your own and you operate there. So generally, any organization would adopt either of these three strategies, which is a leadership, which is the cost leadership strategy. The second one of them is a differentiation strategy, and the third one of them is the niche player strategy. We've got a very important model which is called the Porter's 5 forces model. Again, it's one of those models which you have studied at the SBL level, but again, it's an important model because it could be used for the performance management. What does the Porter 5 forces model says? The Porter 5 forces model says that generally an organization has got the 5 forces which have an impact upon it. What are those 5 forces? It's a bargaining power of customers, it's a bargaining power of suppliers, it's a threat of new entrants, it's a threat from the substitute of the alternate products, and the competitive rivalry. So generally what happens is that when we apply Porter 5 forces model to an organization, we try to identify that what are the forces, how strong are the forces, how weak are the forces. Like for example, if you've got limited number of customers, so the bargaining power of customers is high. If you've got limited number of suppliers, the bargaining power of suppliers is high. If the competition is fierce, so the competitive rivalry is high. If there are no threats from the substitute, no threat from the alternative products, so the threat of substitution is low. If the government has imposed restriction that no new entrant could actually come into your industry, so the threat of new entry is low. So generally as an organization, what you do is that you use the Porter 5 forces for the strategic analysis, and then what you do is that you identify the key performance management issues using this Porter 5 forces model. Like for example, what happens is that you would identify your organization's strength, you would try to leverage upon your strength, you would try to identify the risk areas, the problem areas with your business, and you would try to make sure that you avoid those problem areas. Like um, for example, if you have got threat from new entrants, what as an organization you could do is that you could focus upon enhancing your brand value. If there is a fierce competition, you as an organization could focus upon enhancing the market share. If there is actually the bargaining power of the suppliers, you could try to identify new suppliers. If there's a bargaining power of customers, you could try to identify new customers. You can get into the new industry, etc., etc. So these models, which actually tell you the external or the environmental impact, could be used for what? Could be used for the identification of, I repeat, they could be used for the identification or the introduction of the performance measure which could help you as an organization improve your performance. Stakeholders actually mean every person, every individual, every organization which is affected by the organization. So anyone who is affected by the organization is considered to be a stakeholder. The stakeholder could be your shareholders, could be your managers, could be your employees, could be your customers, could be government, could be customers, could be competitors, could be suppliers. Anyone who could actually be, who would get affected by your organization would be considered as a stakeholder. As an organization, we need to make sure that we map our stakeholders to identify the amount of power that our stakeholders have and the interest that they have in our business. Generally, the Mendelows stakeholder matrix is used for the stakeholder mapping. And what we do is that we identify or we plot our stakeholders on the basis of the interest that they have in our organization and the power that they have. A stakeholder could have a low interest, could have a low power, could have a high interest, could have a low power. I mean, the power could be low or high, the interest could be low or high. So like for example, if there is a stakeholder which has got a high interest in your organization and he or she has got a high power, they are considered to be key players. And what you do with respect to the key players is that you make sure that you satisfy them. You make sure that you follow whatever you make sure that you follow whatever their requirements or whatever their expectations are. You follow their expectations. The second thing is that if there is a stakeholder who has got a high interest but who has got low power, so you don't have to worry about it. You just have to keep them informed. That's it. The third one of them is a stakeholder which has got a low level of interest but has got a high level of power. You got to satisfy them. In a lot of cases, it's usually the government. And there are stakeholders which have got low interest and low power. You don't have to put in any effort for them. So just make sure that as an organization, you got to manage your stakeholders in a manner such that the organization's performance is not being affected. You could be asked about the performance management scenario where you could actually be required to introduce the different performance measures for the different stakeholders. So it's going to be important that before you introduce those performance measures for the stakeholders, you should actually be able to identify or map those stakeholders onto the stakeholder matrix, that what type of stakeholders are they. When it comes to performance management, it's very important that you consider the environmental influences. What do we mean by considering the environmental influences? So when we talk about considering the environmental influences, this actually means that you got to see what are the external factors, what are the environmental factors that could have an impact on the organization. So different types of models which are actually studied at the SBL level are used. The first one of them is the PEST or the PEST analysis. What do you mean by the PEST analysis? The political, economic, socio, and the technological factors. Then you've got the environmental factors and the legal factors. So when we talk about the PEST analysis, what we generally do is that we say what are the political factors that have an impact on the organization. That could be the taxation policy, that could be the employment legislation, that could be the monetary policy, that could be anything. The economic factors, which is the interest rates prevalent in your country, the inflation, the overall business cycle, the social factors, which is the lifestyle that the people have, the income distribution, the levels of education and awareness, the technological factor, the speed at which the technology is advancing, and etc. As an organization, what you need to do is that you can actually use the PEST to identify the critical success factors, and those critical success factors could actually be used for the introduction of the KPIs. So as an individual, as an organization, what you could do is that you could use the PEST analysis for the identification of the CSF, and ultimately hence you would be in a position that you would be able to introduce the KPIs which could help you achieve those CSF, and hence you can take advantages of these PEST factors for the improvement of the organization's performance. A very important point is to deal with the risk and uncertainty when it comes to the decision making. What exactly do you mean by risk? What exactly do you mean by uncertainty? So whenever you are planning for a business, if you are able to assign a probability to an outcome, that means you as an organization are facing a risk. But if you are not able to assign a probability to an outcome, that means you are facing an uncertainty. So a business should actually be ready to deal with the risk and the uncertainty whenever they are making a decisions. And when it comes to dealing with the risk and uncertainty, there are different types of techniques that you can actually cover up. Amongst the different type of techniques, the technique used for the risk is the expected value. What do you mean by expected value? The different outcomes, they are actually assigned a probability, and an expected value of all those outcomes is calculated. How? Like for example, you have an outcome of 100 million profit, 200 million profit, 300 million profit. If there is, let's say, 50% probability of 100 million profit, so you would say 100 million multiplied by 50% plus. If there is a 25% probability of 200 million profit, so you would say 200 multiplied by 25% plus. Then there is this a probability of 25% for 300 million profit, so you would say 300 multiplied by 25%. So resultingly what happened is when we said 100 multiplied by 50%, it turned out to be 50. When we said 200 multiplied by 25%, it turned out to be 50. When we say 300 multiplied by 0.25%, 25%, it turns out to be 75. So when you add up all of them, it's 175 million. So that means an expected value would say that an expected profit is going to be 175 million. So when it comes to the expected value, it's one of those techniques that actually establishes an average value that you will be achieving out of the activities that you would perform as an organization. This technique is used while you are facing a risk, but in case if you are facing an uncertainty. What do you mean by facing an uncertainty? Facing an uncertainty would actually mean that you are unable to assign the probability to the outcome. You are unable to assign the probability to the outcomes. So there could be three different types of techniques that includes maximax, maximin, and minimax regret. What are these techniques of maximax, maximin, or minimax regret? The maximax means that you go for a strategy where you maximize your maximum profits. Maximin is actually going to be the strategy where what actually happens is that you maximize your minimum profits. And the third one of them is a minimax regret, where we actually go about creating a regret matrix The regret matrix is basically a loss of adapting a specific strategy that's considered to be a regret matrix. So what we do is that we create a regret matrix and we minimize the maximum regret. Now, as an organization, which type of a strategy are you going to adopt? So that would actually depend upon your risk appetite. As an organization, if you are a risk seeking organization, so you would go for a maximax strategy. If you are a risk averse organization, you would go for the maximin or minimax regret strategy. And if you are an organization which is risk neutral, you would probably go for the expected value technique. That is something that you will do as an organization. So when it comes to the decision making, the risk and uncertainty have to be incorporated just to make sure that you are able to get a good idea about what a business has to face in case if it takes a certain decision. Let's talk about budgeting. What exactly do you mean by budget? So the budget actually means your future financial plan. That is what a budget is going to be. What do you mean by budget? A budget is your future financial plan. When it comes to the budgeting, there are multiple purposes of a budget, and what exactly are they? A budget is used for planning, that is what is going to happen in future; controlling, that is for the variance analysis; communication, that is across the organization you could tell what are we expecting to do this year; for the coordination, that is to coordinate amongst the employees, etc., etc. And there are multiple other purposes, but the major purposes are the planning, coordination and the controlling. That's what the budget is all about. As an organization, there are different types of approaches that are used with respect to the budget setting, and the most common approaches is termed as the top down or the bottom up budgeting. Top down is a non-participative budgeting, whereas the bottom up is a participative budgeting. A top down budgeting actually means that the senior management of the organization sets the budget and sends it across the organization to everyone that this is what you need to follow, that this is something that you got to follow. This is considered to be a top down budgeting. A bottom up budgeting actually means that you have your department, you have the people at different levels of the organization to participate in the budget setting exercise. The advantage of a top down budget is that if you don't want your employees to be thinking a lot, you don't want to have the budgetary slack. The budgetary slack means inefficiency incorporated, so you would rather prefer your employees to be set at top down budgeting. At the bottom of budgeting is important, where you've got an organization where there is innovation needed, where there is creativity needed, where there are new things that are coming up. So in that situation, the bottom up budgeting is a successful and a better approach. There are different methods of budgeting. The different methods of budgeting include the fixed budget. What do you mean by fixed budget? That is, a budget is prepared at a single level of activity, and this budget is prepared for a certain period of time. It stays constant, does not change with the time. There is another type of budgeting which is flexible budgeting. It's similar to the fixed budget. What's the difference between fixed budget and the flexible budget? Fixed budget is at a single level of activity, whereas flexible budget is at multiple levels of activity. The third one of them is an incremental budget. Incremental means differential. An incremental budget is the budget which is either created on the basis of the last year's budget or the last year's actual performance, and then an incremental effect, which could be an increase, which could be a decrease, could be incorporated. The fixed budget, the flexible budget, the incremental budget, these are the relevant budget strategies, these are the relevant budget approaches whenever the organization is operating in an environment which is relatively stable, which is not changing a lot. So this incremental budgeting or the fixed or the flexible budgeting is an appropriate approach. But generally there is a problem with these approaches, which is that the slacks could be incorporated. These budgets are not efficient. These budgets may not be up to date with what the circumstances could be. At times the organizations, they go for the flexible, at times the organization, they go for the rolling budget. What do you mean by rolling budget? They create a budget for a certain period of time and they regularly review that budget. Like for example, the organization may say that we will prepare a budget for 4 quarters. Like it's not going to be for 1 year, it's going to be for 4 quarters. And once the quarter number 1 has ended, they would review the budget for the remaining 3 quarters and add up another quarter, so they would have a 4 quarter budget at any point of time. The idea of having a rolling budget is to actually update the budget with the changing circumstances that the organization faces. The advantage of this, the major advantage of this is that your budget is up to date, the employees don't get demotivated, and you've got a relevant budget to measure the performance. There's another type of budgeting which is called the activity based budgeting, ideally suited for organizations which apply the activity based costing. Why? What we do is that we use the activity based costing data to set the budget. The advantage of the activity based budgeting is you have got the budget which is set on using the activities which the organization undertakes. So whatever activities that you undertake, your budget actually incorporates them. Then you have got a zero based budgeting. A zero based budgeting is when you start from the scratch. That means you say we don't want to have any base budget. We just going to start from the scratch. That is, every single element, every single item pertaining to the budget has to be justified, has to be considered, and then we are going to be undertaking that a specific budget. So ideally speaking, when you have got a project, when you've got a first time business, you apply a zero based budget. When you've got a certain project to undertake, you apply a zero based budget. When you have got a situation where your existing budget has become very much out of date, has got a lot of slack, has got a lot of inefficiencies, so what you do is that you try to make sure that you go for the zero based budgeting. The advantage, the objective of the zero based budgeting is that the zero based budgeting actually helps you. How does it help you? It helps you achieve an efficient budget. That's what the advantage of the zero based budgeting is there. There's something which is termed as activity based management, which is ABM. What exactly is an ABM? So whenever you implement activity based costing in an organization, what you do is that you are actually able to identify the multiple activities that an organization enters into. The excessive detailed information about the organization's activities is actually identified. So what we do is that we use the ABC data to manage the performance of the organization. How do we use the ABC data for the managing of the performance of the organization? So the activity based management actually are of two types. What are those two types of the activity based management? One of them is termed as the operational ABM. The other one of them is termed as the strategic ABM. What's an operational ABM? What's an strategic ABM? The operational ABM is the one that actually focuses upon improving of the efficiency that the organization has, improving about the value the product adds, elimination of the efficiencies. That's what it does. But when it comes to the strategic ABM, it's used for the bigger purposes, which is the strategic ABM are usually used for the purposes of deciding which products to continue, which products not to continue, which specific customers to continue dealing with, which specific customers to not continue dealing with. I mean, like, which are the ones to be discontinued. The advantage of using the activity based management is that the organization ultimately focuses upon only those customers, only those products which are beneficial for the organization, rather than focusing upon every single customer, every single product that the organization has some way or the other launched sometime, which may not be beneficial now. So modern day organizations, what they do is that they use the activity based management to help them enhance their performances. Variance analysis is a very important control tool that has been used by the management accountant for long. The concept of variance analysis is that you compare the performance of the organization, the actual performance of the organization versus the budgeted performance. If the actual performance is better, that means the variances are favorable. If the actual performance is not better, that means the variances are adverse variances. The variances are further categorized, the advanced level variances are categorized into the planning and the operating variances. What is a planning variance? What is an operating variance? The concept of planning variance is that, for example, an original budget is set, but somehow or the other the circumstances change. So like for example, let me tell you that you had originally budgeted that you will buy 1 kg of material for $10. But now the market circumstances have changed, the situation has changed. You ended up buying the 1 kg of material for $20. So that means the budget was $10, but we are buying it for $20. So there is a $10 adverse variance per kg that is arising. Now who is going to be responsible for this $10 of the adverse variance that is actually arising? So is it the manager? Is it something else? So generally what we do is that we analyze this $10 of adverse variance into planning and into the operational variance. What's a planning variance? What we do is that we say that if we consider the current situation, current circumstances, what is going to be our revised budget going to be? For example, if our revised budget says that the material should be purchased at $17, so that means the planning variance is going to be $7. Why? Because our original plan was $10. Now the revised plan is $17. So the difference between the revised and the original plan is considered as a planning variance, and the revised and the difference between the actual performance and the revised plan or the revised budget is considered to be an operational variance. So who is responsible for the operational variance? It's the managers. The managers are held responsible for the operational variance. And who is responsible for the planning variances? So obviously the ones who are establishing the plan, but again it's not the ones who actually set up the plan. The change in the circumstances is being considered, so no one is actually held responsible for those for actually the change in the plan, because it was nobody's fault. It was actually the changing circumstances that forced the organization to go for, I repeat, it was the changing circumstances that actually forced the organization to go for the revision of the budget. So what is the advantage? If we would have not analyzed this variances into the planning and the operational variances, we would have actually been standing at what? We would have been standing at holding our manager responsible for the $10 of the adverse variance. But it was not $10 of the adverse variance that the manager was responsible for. He was only responsible for $3, which is the operational variance. The other variance was because of the changing circumstances. So the advanced level variances are, you analyze the variance into the planning and into the operational variances.
So that's it for the time being. I shall inshallah be uploading additional videos on this APM revision, but I hope that you have had good time in revising whatever the lectures that were made available through this video. In the meantime, you could get in touch with me on the WhatsApp that is being given on this slide. Plus, you could email me or you could visit our website. So thank you very much. Take care.